Hi everyone, and thank you for tuning into my channel where I post about stocks, the stock market, and investing. I post videos every day, so if this sounds like something you want to get more of, please subscribe down below. In today's video, I'm going to be talking about Netflix and if the stock is a buy. I'm going to use my simple 6-step framework for analysis. So let's get right into it. The first step in my framework is the customer value proposition. For Netflix, it's one of the most expensive streaming services. There's several competitors that are priced lower than Netflix. There's also free options like YouTube where consumers can stream content without paying a price. And so Netflix is on the more expensive side. Still, it offers lower prices and better convenience compared to traditional cable TV or satellite TV bundles. Okay, revenue has increased from 3.6 billion in 2012 to nearly 30 billion in 2021. So consumers are saying that they like what Netflix has to offer. Revenue has increased more than sevenfold in the last 10 years. So that's consumers voting with their dollars, saying they like the customer value proposition from Netflix. The next step in my framework are the unit economics. For Netflix, it spends a lot of money creating content, but then those content costs are spread across its subscriber base. If you can imagine, it doesn't cost Netflix that much more to show its content to 10 million people as it would to show its content to 20 million people or 30 million people. So in that regard, it can spend money on the content once, and then each incremental subscriber that comes on, most of that revenue flows to the bottom line. So that's an excellent unit economics business model there. Furthermore, those movies and series that it creates become long lasting assets. Uh, Stranger Things, they've got 4 seasons of Stranger Things. That's up there on Netflix now. So subscribers from next year or the following year that are new to Netflix for the first time, they can go on there and watch those 4 seasons now. That's something that's going to be completely new to them, and this can happen for the next 5 years, 10 years, arguably for the next 50 years to 100 years because content is long lasting. It doesn't disappear. It's still up there. So this allows for nice economies of scale for Netflix as its investments are spread across a wider user base. That can explain why its operating profit margin has expanded from 1.4% in 2012 to 21% in 2021. So clearly demonstrated economies of scale for Netflix. The next step I like to consider is the total addressable market. For Netflix, their total addressable market are the 1 billion households with access to the internet. That's a massive addressable market. Compare that to where they are today with 220 million subscribers, and it suggests that there's room for them to grow further. Moving on to competition, which is the next step. Netflix had several years where it had very limited competition. It was essentially the only streaming provider out there. But during the pandemic or in the recent 2 or 3 years, several notable streaming subscriptions have launched. Now, Netflix has to compete with Disney Plus, Hulu, Amazon Prime, HBO Max, Paramount Plus, YouTube's free and premium version, and you can argue that TikTok is a competitor as well. Netflix is one of the more expensive of all of these, and the rest of the competitors, the newer competitors like Disney Plus, Paramount Plus, and Peacock, which is not listed here, they all came in with the introductory pricing, really low pricing, and that suggests a fierce competitive environment. When competitors are trying to undercut you in their prices, that's that's an indication of strong competition. That's an indication that they want to take your customers, they want to attract your customers with a lower price. So, competitors pricing their services at or below Netflix's prices. However, many of them are generating massive losses on the bottom line by doing that. So even though they're pricing below Netflix's prices right now, that's an unsustainable model. They can't continue at these prices because they're losing tons of money on the bottom line. For instance, Disney's streaming service lost 1.1 billion in operating income in its most recent quarter. So that's unsustainable. Disney's not going to lose over 4 billion annualized operating income on its streaming services. Eventually, it's going to increase prices to stop those losses on the bottom line. My next step in my 6-step framework is valuation. And looking at Netflix's price to earnings ratio, it's trading at 20.09 PE, which is near the lowest it's been dating all the way back to 2018. That suggests the stock is relatively inexpensive. The final step in my framework are risks. For Netflix, one of the primary risks right now is competition. If competition stays as fierce as it is right now over several years and stays that way for the longer term, that could indicate that the industry overall is going to experience lower profitability. So the streaming industry is relatively new. Investors don't know where the competitive pressure is going to settle, where prices are going to settle. Are they all going to offer subscriptions at roughly $15 per month, or is it going to be around $20 per month, $30 per month? Where is that ultimate price point going to be where the services stop increasing prices and also stop losing money on the bottom line? That's an unknown, and unknowns are a big risk. Another risk for Netflix is that it has less experience in creating content compared to some of its competitors. You think of the Walt Disney Company, think of Paramount Studios. These companies have had decades of experience creating content that consumers love. Netflix has only recently started creating content. So it has an experience disadvantage compared to its rivals, and that can be a risk. All right, now we're approaching the verdict. So let's review the scores or the ratings I gave Netflix in each one of the categories, and then we'll talk about the verdict. So Netflix's customer value proposition I said was good. It wasn't excellent because there are lower cost providers. So we gave it a good because it was ahead of the cable and satellite bundle, but not ahead of its competitors. I noted that Netflix's unit economics were excellent. Its total addressable market was excellent, but its competitive position in the competitive position in the industry is poor. Rivalry is fierce right now, lots of introductory pricing, companies willing to lose billions on the bottom line to attract subscribers, so that's a poor competitive environment. Moving on to its valuation, I noted that Netflix is inexpensive. However, risks are high. So several good ratings for Netflix there. Two of them not so good. The two that are not good are the competitive position and the risks. Overall, when I considered everything, I would still rate Netflix a buy. And the two things that are swaying me in my decision most strongly are the inexpensive valuation and the excellent unit economics. These two factors are so good that it allows me to overlook some of the other negative aspects for Netflix stocks. But let me know what you think. Comment down below. Let me know what you think of Netflix stock. If you liked what you saw, please subscribe down below so I could keep producing content like this. All right, thank you for watching.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular Stock Advisor. Stock Advisor has beat the market by more than 250%. Go to fool.com/Parkev to get your 10 stock picks now.